Okay, brilliant. I think we can get started. So welcome everybody to today's roundtable webinar on the state of private equity valuations in East Africa in partnership with I&M Burbidge Capital. If you're unfamiliar with the East Africa Venture Capital Association, we are the industry body that represents private equity and venture capital in East Africa. Our mandate covers 5 countries: Kenya, Uganda, Tanzania, Ethiopia, and Rwanda. And our membership is at about 100 firms, private equity, venture capital, and financial advisory firms spread across the region. Today, we are holding this roundtable in partnership with I&M Burbidge Capital on a topic that our members have raised several times as a major concern during these unprecedented times. So today we have a presentation on the market trends in private equity valuations in the region. We are glad to be joined by Edward, who has been able to share with us the report that they've worked with PKF East Africa, looking at the trends in valuations over the past 6 months. We're lucky to have first glimpse at it. I sent it to you prior to this webinar call, and I hope you've had a brief look at it. If not, I'm sure Ed will be sharing insights into it and bring out the key concerns and issues with the panel that we have before us today. Speaking of the panel, we are joined today by 6 great panelists, led by the moderator, Edward Burbidge, who is from the I&M Burbidge Capital. We're also joined by Darshan Shah from PKF East Africa, David Lekarai from IKM, David Rohino from Ascent Capital, Martha Osier from Adenia Partners. I'm really grateful to have you all this morning, and I will pass the virtual microphone on to Edward right now. Thank you.
Okay, thanks very much indeed, Esther. Morning, everybody. Thanks a lot for joining. As Esther said, we put out a report about an hour ago, so you have to have been fast readers if you've got through it by now, in conjunction with PKF. Obviously, my firm, I&M Burbidge Capital, is one of the more active transaction advisors in the East African market. We're currently handling about 10, 12 deals under offer. We had a deal completed last week. And so, we're regularly transacting. And so we felt that we were hopefully in a good position to share some interesting insights on valuations and how they're being impacted by COVID. We brought in PKF obviously because there's quite a technical accounting and tax element to these things. So we were delighted that Darshan and his team teamed up with us in collaboration on that report. And what we'll just do now, before we head into the panel where we will be discussing these things live with some of the other major industry players, representatives, I'm just going to take you through a brief of the executive summary of the report to sort of bring out the key points that we discovered in relation to what's happening with adjusting COVID valuations in transactions right now. I'll summarize the market corporate finance side, and then I'll hand over to Darshan, who will just briefly do the tax side, and then we'll move into the panel session. Okay, so what we discovered was that really the impacts are very different across different sectors, and so you obviously can't generalize. It has to be quite specific to the sector that you're examining on a transaction basis. Some sectors, of course, have actually benefited, if that's the right word. Trading is actually up, whereas others have been hit incredibly hard, unfortunately, by it. But in either event, it needs to be normalized because they're not normalized earnings that we're seeing in this year in particular. We also uncovered that the cost of equity is, on balance, increasing. I don't think that'll be much of a surprise. We're all seeing stock markets drop. In fact, a number of them are recovering quite a lot, but certainly in East Africa, quite a few of the markets are down quite a lot. And effectively what that is equity investors pricing in a higher level of risk and therefore expecting a higher level of return. Conversely, on the debt side, we're actually seeing cost of debt decreasing. There have been massive central bank interventions internationally and monetary policy interventions, which have meant decreases in interest rates and decreases in yields on government bonds. And so you've got almost neutralizing effect from the fact that the cost of equity has been increasing and the cost of debt is decreasing. Obviously, that depends how leveraged the business is as well, and we go into some detail in the report on how to make the correct adjustments to cost of equity and cost of debt. When you're getting into DCFs, then it becomes increasingly important to have granulated and realistic forecasts, particularly for the expectations for the rest of 2020 and going into 2021. Obviously, you know, budgets that companies started the year with need to be reassessed, but even more than usual, those first two periods need to be looked at in a granular fashion and in a realistic fashion for you know, what's going to come out of COVID adjusted cash flows in 2020 and 2021. It is possible, we've discovered, to reverse engineer an EBITDA for 2020 for companies that either have very sort of steady recurring revenues, I guess that sort of goes without saying, and steady costs, but also for companies where revenues are heavily contracted, right? So, you know, you could have started the year with a lot of contracted revenue. It's been delayed, but not taken away altogether. And so that gives you an opportunity to attempt to re-engineer the EBITDA as we move towards the end of this year. Where that's not possible, which is quite a lot of cases, what we'd recommend is using an average of the last 3 years EBITDA, okay, up to 2019. When you're getting into comps, we talked about DCF before. The other key element of valuations for most sort of standard operating businesses, the comps, the transaction comps and the trade comps. What we find is that at the moment, transaction comps, if for most industries, are probably looking a bit high because most of those transactions, of course, were done pre-COVID, and so the comps are not adjusted. As we move forward towards the end of the year, that will change, of course, as deals are being done now. You can use that deal data, but mostly we're using historical transaction comps, and so they're coming out a bit high. Trade comps are coming out a bit low on the basis that, you know, stock markets have been dropping, market capitalizations have been dropping, and so, you know, as a result, they reflect often a bit lower than the multiple we would usually see. And quite a neat way to cope with that is to average the two. Yeah, fairly straightforward, and that gives you some kind of neutralizing effect on the fact that those transaction comps are high and the trade comps are coming out low. With a reference to net assets is always, you know, for a standard operating business, not really appropriate because it doesn't reflect the future earning potential of the business. But as a sanity check, a reference to net assets is even more important than usual. And in some cases, you may even need to be adjusting the asset values, actually. So finally, I think in cases where you really can't find fair value, where it remains elusive, despite all of these things, then it is possible to use deferred consideration and valuation adjustment mechanisms to close deals right now. I think the problem with that, and we're going to discuss this a bit with the panel, is you then have to have yet another emotional discussion between investor and promoter 2 or 3 years down the line, right? And that's distracting for the investor and for the business owner. So I guess I'm more in favor that you try and find fair value now rather than those deferred consideration structures because of that distraction and further emotion down the line. However, in some cases, it becomes necessary where the sides can't agree on a fair value adjustment. Okay, I think the final thing is, to my mind, we're heading into the most affected period right now. Okay, I think the next 10, 11 months are when these adjustments are going to be most required. If you think about it, you know, the deals that we were working on and moving towards closing in the first half of 2020, we were still working on 2019 EBITDA as being a sort of normalized EBITDA. Now we're moved into the second half of 2020. those 2019 EBITDAs are starting to become out of date. Yeah. And I think as we move into 2021, it's quite likely, assuming we're through COVID by then, let's hope that we are, and assuming that we are for most of 2021, then probably from the second half of 2021, we'll start closing deals based on expected EBITDA for 2021. So if you see what I mean, I think for the next 10, 11 months, we've got a sort of period where it's going to be really tricky and we really have to work out these adjustments. All right, so I hope that's a helpful summary. We'll discuss it all in much more detail with the panel. But I now want to just hand on to Darshan, who will give us a quick summary of one or two of the key tax impacts in adjusting COVID valuations. I think you're still on mute, Darshan.
Thank you, Edward. From a tax perspective, it was expected that the government would issue a raft of measures. But whilst there was a lot of politicizing about reduction of the corporation tax rate, reduction of the income tax rate, VAT rate, etc., but the government has come about with a lot of counterproductive tax measures, in my opinion. Some of these are significantly likely to impact valuations in the future. We have this new scheme about the minimum tax of 1% on turnover coming through from next year. Initial discussions with KRA look like that this tax will never be recoverable in the event that it is overpaid. So it's an additional burden to many companies that survive on low margins, that do not have even enough capital at the moment for the future. In line with this, we also saw a significant reduction in capital allowances provided to manufacturers. And in my view, manufacturers are the backbone or one of the key backbones of this economy, creating employment. But a reduction of these allowances, we are already starting to see projects getting deferred, projects being reduced in size. And then one of the larger impacts is the increase in the withholding tax rate for dividends paid to non-residents. Again, are we trying to push away foreign investors? It's a big impact. And with COVID at the moment, with the elections 2 years down the line, I do personally feel that a lot of these measures are counterproductive. But it's obvious that the government also needs tax cash flows in order to take us through this period. So that's my view. Thank you, Edward.
Okay, thanks, Darshan. And we'll get into one or two of the specific points on IFRS choices, etc., during the panel. But so let me now move into my panel discussion, and I'd like to start by just allowing each of the panel members to introduce themselves and their organization briefly before we get into the questions. What we're going to do, by the way, just so I can let the participants know, a bit of admin, please submit your questions in written form on the Q&A form. If you can type them in as we go along. What I really want to do ideally is to have those questions at the end, and we will, don't fear, we have allocated 15 to 20 minutes for those questions at the end. We're really keen to get questions from you as we go along, so please do put them in. I will keep a note of them, and we'll come on to those participant question and answers at the end. Okay, but let me please kick off with Martha and ask her to introduce herself and Adenia.
Thank you, Edward. Morning, everyone, and it's a pleasure to see a lot of you on the call. Yes, Adenia Partners is a private equity fund established around 20 years ago now. We are based out of Mauritius and have a presence in 5 countries in Africa. So we have an office in Madagascar, Cote d'Ivoire, Ghana, as well as Kenya and Mauritius. Right now, we are investing out of our 4th fund, which is a $230 million Euro vehicle. We invest across sectors, so we are sector agnostic. Our minimum investment right now is anywhere from, say, 10 million euros or $12 million up to a maximum of 30 million euros. And we can invest larger sizes with some of our investors, 50% of whom are the DFIs. So we have IFC, CDC, FMO, a lot of the DFIs who are active in the region. And the other 50% is from private high net worth individuals and pension funds. In East Africa, so I head up the East Africa office, where we cover Kenya, Uganda, Tanzania, Ethiopia, and to some extent DRC. To date, we have invested in retail, so that's grocery retail. We've invested in Quick Mart supermarket. And we've also invested in a heavy equipment distributor called Kanu Equipment. They are present in 11 countries in Africa. So I'll leave it there for the introduction.
Fantastic, Martha. Now I'll hand on to David Rohino to introduce himself and Ascent, please.
Thank you, Ed. I was hoping you called me next. Yeah, so my name is David Rohino. I won't spend so much time because the investors that are backing Ascent are the same investors that are backing Adenia when it comes to the DFIs. At least some of them, they are a much bigger fund than us. Ascent is an SME fund focusing on investing in Kenya, Ethiopia, and Uganda. We have offices presence in all those three countries. So we have an office in Addis Ababa, Kampala, and Nairobi. The fund is domiciled in Mauritius. We have an interesting mix of investors, just like Adenia. I think about 60% of our investor money comes from DFIs, and 40% from commercial investors, mainly out of Europe, and also pension funds from Kenya. We are on our first fund, and we are now in the process of raising our second generation fund, which will be $120 million, focusing on the same countries or territories, same investment strategy, SMEs, but in our fund two, we will then also cover Rwanda and Tanzania as part of our territory. Thank you, Ed.
Okay, thanks, David. And by the way, you're probably a highly intelligent audience, so I'm sure you're getting the picture that the idea with the panel was to have a cross-section of the industry, GPs, LPs, legal, tax, and transaction advisors. So we'll now move on to the LP DFI side of the equation, and I'll hand over to William to introduce Norfund and himself.
To be part of this conversation. My name is William. I run Norfund in East Africa. Norfund is Norwegian DFI, I think, for you. As you understand, DFI means the Development Finance Institution. So we are owned by the Norwegian government, and our mission is to invest in sustainable.
It's a bit scratchy actually at your end, sorry. I don't know if there's anything you can do about that.
Can you hear me better? Is it better?
It's still a bit scratchy actually.
Okay, let me just use my headphones. Can you ask someone else to go ahead?
Yeah, sure. Okay, that's fine. Let's do that. Okay, so now let's hand over to the legal mind, which is David Lekerai, partner from IKM. Perhaps you could just briefly introduce yourself and IKM, David.
Thank you, Ed. My name is David Lekerai, partner at, in the corporate practice at DLA Piper Africa, which here in Nairobi, we are commonly known as IKM advocates. We are a full service commercial law firm, and I will explain exactly what we typically mean by that. Over 70 lawyers in Nairobi, operating across 6 practice groups. And that includes our practice group corporate, which covers M&A, private equity, capital markets, and regulatory advisory mainly. We then have a commercial employment, and IPT. I'll just mention those in passing without explaining what exactly they deal with. A tax practice, projects, energy and infrastructure, real estate and finance, and last but not least, which is a quite critical practice, especially given the current developments in the market, is a dispute resolution, or what we otherwise know as litigation practice group. In Africa, we are in 20 Africa in total, over 100 partners, and spreading, and we're able to do deals. We've been involved in some of the largest or significant deals in the region over the last couple of years. Last year, we did actually win the Deal Makers Award, the Deal of the Year, and the Private Equity Deal of the Year. But what I meant, Ed, just to give it context, by a full-service commercial law firm, you will not find us involved in criminal matters, which is unfortunate, because most of my friends, when you're interacting with them and you're saying, I'm a lawyer, they'll say, oh, when I'm in problem that I should be able to come to you. And matrimonial causes as well, given, of course, how emotive some of those matters tend to be. Anyway, thank you very much. Happy to be part of this panel and look forward to the discussions.
Thanks, David. Very sensible to stay out of matrimonial matters. That's for sure. Darshan, I'm a bit nervous after your opening remarks if you're going to be making some sort of heavy political statements that might get us all into trouble. But can we ask you maybe to do an intro on PKF and just briefly some of the things you do in the market relating to transactions?
Thank you, Edward. So we are a firm of accountants. We do the normal suite of services, audits, due diligences. We have a large tax practice arm. We do management consulting as well, and outsourced accounting. So the normal suite of services that a practice would offer. We are part of the PKF franchise, but our economic partnership is headquartered in Nairobi in Kenya. We have 5 offices in Kenya, all the way down to Malindi, Mombasa, Nakuru, Kisumu, and of course Nairobi. We have an office in Uganda. We have an office in Rwanda. We have 2 offices in Tanzania, in Arusha and in Dar es Salaam. And we have 2 offices in the UK as well. So this allows us to provide a very regional service. In terms of transactions, we generally provide tax support to transactions, due diligence support, other financial accounting support as well. We've also handled a lot of dispute resolution work around accounting, litigation support as well. We currently have about 40 partners in the region and in the UK as part of our economic partnership, employ about 800 staff or so. Yeah, thanks, Ed.
Fantastic. Thanks, Darshan. William, how are you getting on? Are you back in business? Take that as a no. Yeah, okay, fine. I'm sure that he'll join again in a minute. I'm just going to very quickly give you an introduction to I&M Burbidge Capital as well. So we are East African corporate finance advisory firm. We're headquartered in Nairobi. We also have an office in Kampala. I'm the CEO and founder. These days I only earn 35%. I did my own M&A deal for a change instead of advising others in 2016, and I sold 65% to the I&M banking group that I'm sure you'll all know. So we became I&M Burbidge Capital. That gave us a further presence across the region, Rwanda, Tanzania, Mauritius as well. So it completed East Africa for us. I think we're the market leader in terms of volume of deals done. Last year we closed 7 or 8 transactions. We do M&A, PE, debt, mezzanine, and capital markets. So all the types of corporate finance transactions, all of the major sectors, and across all the countries in East Africa. I would add that we've got quite a successful track record in PE exits. We've done 2 or 3 of those successfully already, and we've got 2 or 3 others we're advising at the moment under offer. It's going to be an interesting time for exits, so do feel free to come to us when you're ready for that. It's taking my opportunity there. And I can see that William is back. So William, can we hand over back to you to introduce yourself at Norfund?
Sure, I hope you can hear me better now.
Yeah, I think it's a bit better.
Okay, sorry about that. I have technology issues. Just blame it to COVID, it's not me. So as I was saying, so Norfund is a Norwegian DFI. We're owned by the Norwegian government. Our mission is to invest in businesses privately owned in developing markets to create jobs and promote sustainable development. We are present in 3 continents. So Africa is our primary actually investment destination. We have an office here in Nairobi, Ghana, and Cape Town. So 3 regional offices in the continent. But we're also in Costa Rica, in Latin America, and East Asia with an office in Bangkok. We invest in 4 main sectors, primarily clean energy. So one of our main investments in Kenya is the Turkana Wind. And then we also invest in financial institutions, where Equity Bank is one of our flagship investments in the region. But we also invest in what we call scalable enterprises, which is primarily food and agri, but also manufacturing. So we have investments in Africado, for instance, in Tanzania, which exports avocados to Europe. And here in Kenya, we are in a logistics company called Freight in Time. In addition to that, I think, as Edward was mentioning, I'm the only LP in the room. So we also invest in funds, and David Owino's Ascent is one of them. Very proud of you, sir. But also, most recently, we introduced a new sector, which we are trying to build. It's not easy. We are calling it green infrastructure, but just a nice name for waste management and water supply. It's a difficult sector, but we're trying to see how much we can push in that segment. As a fund, we are a $3.5 billion fund at the moment. Around 800 million of that money is invested in East Africa, and half of it is actually invested in the continent. So Africa is primarily, our target when it comes to investment. Our minimum ticket is $5 million, but the top is depending on what the company needs. We can do equity and debt, including local currency debt. So I think that's something that I also want to underline. That as a fund, as opposed to other DFIs, we actually keen to do local currency debt when the conditions allow, of course. I think in a nutshell, that's Norfund. In terms of team, we are 10 in Nairobi, covering East Africa, which includes Ethiopia, Somalia, South Sudan, and the normal East African countries that all of us know. So that's Norfund in a nutshell. Thank you.
Thanks, William. We had to listen quite hard to hear all of that, or I did anyway, but it was certainly worth it. So thanks very much for that. Great, so let's go into our first panel question then. And this one I'm going to direct towards the PE participants. So David and Martha, and perhaps starting with Martha, have you changed your approach to valuation as a result of COVID? And does your IC scrutinize valuations more closely these days?
In terms of Adenia's methodology, as you know, we have a portfolio both in Fund 4 as well as in Fund 3, and that is, I would say, spread across Africa. So when COVID hit, we took the view that we should not change our methodology. So because we believe consistency is key, otherwise your valuation will not be believable otherwise. So what we saw in March, or at the end of March, so we report our valuations to our LPs on a quarterly basis, is that you had, call it, on an LTM basis, very solid earning portfolio. Obviously, we had some in the portfolio, like the grocery chain, that benefited a little bit at the end of March, but you had some companies in our portfolio that, let's say, had supply chain tied to China, that had already started feeling the impacts of COVID in Q1. But on the whole, I would say, because at the end of March, you have backward earnings, the portfolio had relatively solid earnings. The biggest impact at March, which you've all seen, was what was going on in the markets. So we generally apply a multiple, which is sector specific for all the various portfolio companies. And in March, when the markets went down globally, a lot of our multiples were affected. So generally, we would take a discount at acquisition to market multiples. This, I'm sure most of you know, is because of liquidity and the size of companies in East Africa or in Africa in general. And once you have that very, I'll call it abnormal multiple applied to solid earnings, you generally had a dip in the portfolio. I would say maybe just a few exceptions actually went up. So as a fund, we decided to stick to that methodology and take the hit, if you will, in March. What we've seen in June, so 30th of June, there's been some recovery in those multiples, but more and more now you could say Q2 is when the earnings were really hit. Hopefully for some, this will be the worst. For other companies, it might come in the next 2 quarters. So in June, we see a slight improvement in the portfolio, but again, we felt that it was important to stick to the methodology, otherwise it would not be believable.
And your IC, sorry, yeah, are you getting a more rigorous interrogation?
In terms of the IC, I think because there's not been a significant change in the methodology, they are, we've not received, more scrutiny on that. I think some of the investors felt that we were maybe being too conservative or taking too much of a hit, especially in March. But at the same time, it's not like we were selling any of those companies in March. So you could say the valuation was a bit theoretical. We did complete one exit on April 1st. We completed an exit of Movilac, which is a paints company in Mauritius. We sold that to Ascent Capital. Obviously, that had started before COVID. The discussions were probably signed late last year, but thankfully there was no price reduction or there was no change in terms. So again, because of that, which was a good exit, overall Fund 3 was performing quite strongly at the end of March.
Okay, thanks, Martha, and congratulations on your exit in early April. That was clever timing, and a reminder of how important market timing is actually for valuation. All right, so let me ask the same questions to David. I know David usually holds reasonably firm views on things, so we'll look forward to hearing how you're approaching valuations at the moment, David.
Thank you, Ed. Can you hear me? Good. Yes. So I will not repeat what Martha said. I think coming to the end of March with COVID hitting, what I can just add to what Martha said is there was a danger of a double dip where you're seeing earnings going down and multiples going down. And if you're using comps, for example, to value your businesses, you are getting some, I would say, ridiculous values of the businesses. So you look at your net asset value of the business and you look at what comps are bringing out, and so it's way, way below net asset value or even breakup value of the company. And so you sort of have to figure out how you calibrate the valuation so that you can give a better, fair view. What we did at Ascent, I think we took the approach, I think maybe slightly after March, after Q1, to try and bring in projected valuation. So, for example, try and bring in DCF to see if this didn't make sense and all that. But the one we've seen in the continent, or in East Africa for that matter, and I guess everybody who's on this call is seeing it, is we are seeing this uncertainty brought by COVID, which is affecting performance of the businesses. And like Martha said, Q1, if you look at the last 12 months, Q1 was only affected in March, and in fact, the last 2 weeks of March. So last 12 months performance wasn't that affected if you're looking at valuations for and earnings to that particular point in time. Not much effect apart from the multiple dip that we had. But coming into Q2, you start now taking in more and more the COVID effects into your numbers. You start getting that uncomfortable feeling. But beyond COVID, I think, and I think besides Uganda, I cannot talk for Tanzania, but at least Kenya and Ethiopia, we've seen serious currency devaluations happening, right? So you can imagine that COVID is affecting performance, multiples are down, and then the currency is not helping at all. And even when you try projecting forward and using DCF, which relies on a lot of assumptions, the problem was, how sure are you about that the COVID thing will be only for 6 months, for 12 months, right? We don't know, and coming up with your work, and like you said, Ed, earlier, the problem was many businesses don't like debt. People still assume that debt is much more expensive than equity. So you'll find that most businesses don't take in debt at all. So you start working in your work and you start getting some crazy weighted average cost of capital that in their maybe their 30s or not their higher 20s. When you calibrate that with multiples, you're even getting worse valuation. So everything is up in the air in terms of valuations. And I guess the only way out is to see if there's still interest in the market. For example, from not just PE players, but for example, for industry players. So people want to come into Africa or into East Africa. Is there still interest in the long term that perhaps these things will even out? The key thing here is uncertainties that are brought by currency devaluation and the global pandemic itself. And also, like I think Darshan explained earlier, we are moving into very uncertain periods. Ethiopia is going to go into an election very soon. How will that affect the operating environment and for the businesses? Kenya is going to go into an election very soon. Uganda is going to an election this year. Tanzania is going to an election this year. So you're finding there's a lot of stuff that's happening in the operating environment we are in at the moment. And so from a portfolio valuation perspective, you can take the comfort, like Martha was saying, it could be theoretical and you have another quarter to look at things. But the biggest problem is entry. Now, when you're buying investments, is it the right time to buy investments? How do you calibrate valuations? And to speak to that, I think we are coming into a point where we are seeing valuations, and I got this from your report, valuations are sort of cooling off from what they were before. I never really liked where they were before. But at the same time, you're not sure if that's really the bottom or things will get worse. And so we have to come up with interesting transaction structures that are looking into this. But in looking into entry multiples now, if you're looking to buy, we actually did factor in COVID effects, or we factored in somehow COVID effects into the businesses that we're looking to buy. And we are making this very clear to the potential parties we're dealing with that we are not going to be using 2019 numbers. We're going to be looking at 2020 numbers and then calibrate and agree on a mechanism that will then be fair to all parties over the next 1.5 years, depending on how this pandemic goes. Thank you, Ed.
Yeah, thanks, David. And I'll come back to that point on transaction structures that can be used to adjust for this a bit later. It's a good point. Thanks for bringing up the regions as well. I know, there are quite a few of the participants, particularly from Uganda and other parts of the region too. So it's good if we can be talking on a regional basis where possible. All right, so I'm going to take it over to William now and see what's happening in the DFI world. William, what sectors, you mentioned already the sectors that you're most active in, and what are the valuation impacts that you're seeing in those sectors at the moment?
Thanks a lot, Ed. I think, post-COVID, or it's not yet post-COVID, since COVID, we are more active in some sectors than others. I think clean energy right now, projects are not happening, and so we're not as active as we would have wanted to be. So the sectors that we are seeing a lot of activity, especially in Norfund, is mostly on the scalable enterprises side, which is manufacturing, food and agri. So that's a space that we're currently looking at a lot of deals. And in terms of valuations, I think I agree with what have been said by David and Martha regarding the uncertainty around the environment. And us as a long-term investor, we are less concerned about the quarterly valuations of the portfolio. Our concern more is about the entry where are we entering some of these transactions? And the conversations we are mostly having with our targets is, no one knows where the bottom is going to be. And even for some businesses that seem more resilient than others over the last 6 or so months, are also affected by the overall environment. So supply chains and deepening of demand from the market overall. So even those ones, we are trying to see, what kind of multiples do we come in? And the way we've looked at this is to avoid double dipping, we're less discounting the multiples as such. So we are more or less using, historically, where do the multiples settle in the different sectors? But there's more focus on the projections. Definitely not looking at 2019 numbers, but even when you're talking about the last 12 months, we are trying to agree with our targets that our last 12 months is going to include up to the last month when we are closing, so that we count from that month going backwards to avoid, using numbers that actually are not reflective of what the situation is. But, it's very difficult to do DCFs in this environment, or as has been said, the works just don't make sense. So it's boiling down to really, do the parties want to do the deal? And if they do, then what are the parameters that make sense? And you're going to come back in terms of the kind of structures that we're trying to use to make things work. But in terms of valuations, I think I'm seeing more scrutiny on leverage, and not just financial leverage. I think traditionally people are more focused on financial leverage. We're also looking at operating leverage at the moment. So how do you sit with your fixed costs versus your revenues, right? And that, I think, traditionally was not a lot of focus. We used to look at, how much debt do you have in your book? But right now we're looking at, from an operating leverage perspective, where do you sit? And then that feeds into the valuation. But also, I think from a debt perspective, we also, when looking at these valuations, we are looking at, what's the fair value of this debt? We don't want to sit in a situation where it's only the equity investors who are taking the hit from a future cash flow perspective. So the debt holders conversation, I think we're seeing some cases we're actually saying, we are not going to underwrite existing debt in the business. We have to have a conversation with these debt holders to see how do they get impacted also by the downturn that we expect from the cash flows going forward, so that we are not literally coming in as new investors guaranteeing future exit for existing debt holders. So those are some of the conversations that are nuanced conversations that we're seeing in the discussions around valuations. But I think going forward, where I'm coming out, and I'm going to stop here, is it's clear that no one really knows how to value companies in this environment. So we are all trying to see what works, but at the end of the day, it's all about between the parties, how do they feel comfortable agreeing on something. But I don't think any valuation in the market at the moment is the right valuation. Even the fair value is not known from my view.
Yeah, that's an excellent summary. And you talked about debt. I wanted to ask you about this actually, because you mentioned that you have a local currency debt product. What I wonder, and we're looking at designing products around this at the moment, is whether we're going to see a lot more leverage-based transactions now that interest rates have fallen so much. More perhaps a developed markets private equity model where returns can be leveraged up with much cheaper debt than we've seen in the past. Could be quite interesting. But what are your views? Do you see that developing?
So I think I'm sitting on two sides of that conversation. So one is, what is causing the debt prices to come down? In my view, I think it's largely because there's no takers of debt out there. Companies are not borrowing for expansion. That's really what most businesses borrow for. And even for working capital, a lot of it is, there's not enough working capital flow going on, at least over the last few months. And the second part of that is how long do we expect these this low price debt to exist in the market. No one knows. I don't know how long it's going to take. So to answer the question, are we likely to see more leverage kind of transactions? I still don't think so. I think if you're in a situation of uncertainty like this, where you don't know how the future cash flows are going to play out, the worst place you want to be is to take on debt. That is going to either force the equity owners to honor the debt because you don't know, or they have to sell sell the asset of the company, which I think it's just to the detriment of the equity owners. So my simple answer is, I honestly don't think that the low price of debt is going to push people to take more debt, because one, there's no reason to take on more debt because expansion of capacity is curtailed by the general low growth in the market and just the uncertainty of how the market is going to play out going forward. And secondly, I think it's just because, like David said before, I think a lot of people in this part of the world also are just not interested in debt. They think debt is more expensive than equity, interestingly. So I don't think the low price of debt is going to encourage people to take on more debt, because the market is just not ready for more debt, in my view, at this moment.
Okay, thanks a lot, William. Let's take it over to the legal side of things now. David, what I was curious about in particular is what you're seeing on ongoing transactions in terms of new clauses coming into SPAs, shareholder agreements, deals that are already under offer, material adverse change clauses. How are they being exercised? How are you avoiding seeing them exercised? And generally, what would you advise in terms of legal structures that can tackle this at the moment?
Okay. Thank you, Ed, and I hope you can see and hear me well. It looks like my internet is a bit unstable, so just let me know if it hangs up at some point. And for the rest of the attendants, you will forgive me if I mention some things which are very basic, but I think it would just be good to give a bit of an overview or how exactly it works once the deal makers, if you like, or the people and the team who have come up with the valuation have settled on a number or a mechanics of determining that number at some point. Then what exactly do we, as a transaction advisor, particularly from the legal side, then pay attention to? So in terms of document structure, SPAs and subscription agreement or any other investment agreements, we typically classify them or categorize them into three broad areas. I'll mention them quickly. That's the operating clauses, the monitoring clauses, and what one may call the boilerplates, your usual governing law, confidentiality, and so on and so forth. There isn't much happening or changing on that last category. But on the first two, the operating clauses, which deal with the nature of the investment, whether you're talking of common, ordinary shares, preference shares, or convertible, the purpose of the investment, and the exit mechanism, and there's quite a bit of work or negotiation going around there. Same case for monitoring clauses that cover matters such as condition precedent and representation and warranties, undertaking covering information rights, ESG covenants, board composition, and so on and so forth. So why exactly is this issue of valuation, the topic of valuation, key or important for contractual documents at the moment? Most transactions tend to have what is called a gap between signing and closing. If it was the case that you can just complete a transaction on signing, then we wouldn't be worried too much, although of course you never know what COVID brings about with this issue of valuation or what effect it would have on the number or the mechanics the parties have agreed on. However, since there is that gap, which is brought about by a number of issues such as the need to seek or obtain regulatory approvals, the need to address issues that have been identified at due diligence, whether you're talking of tax due diligence, financial or legal, the need to seek consent of certain counterparties such as lenders, then you then have that gap, which means the number or the basis on which you agreed to do that deal at the beginning, at the point when you signed up, could end up being fundamentally different at the time when you are completing the deal. Traditionally, and that you mentioned this concept of material adverse effect, it has been one common feature of safeguarding a transaction against the negative effect of what would happen or a faltering business between signing and completion. Yet, at the same time, the concept or aspect of deal certainty is one extremely important element that parties must pay attention to, especially for the target company or the seller and the sponsor, because you signed up, you obviously spent quite a bit of time, invested resources, you would want clarity or certainty that at the end of the day, once some of the mandatory conditions have been fulfilled, that deal would be completed. However, of course, the investor would also require appropriate safeguard to ensure that the business has not significantly changed from what they thought it was at the time of signing up. Hence, that concept of material adverse effect. What we are now seeing as a result of COVID is a more elaborate and a more subjective way of determining from the investor side what would constitute a material adverse effect. Some have gone or are going to the extent of actually mentioning issues or an adverse effect arising as a result of COVID. The subjectivity elements include the opinion of the investor being the one that determines whether that effect has occurred or not. You could end up bringing some element of reasonability in that discussion about the opinion of the investor. And some have the proposals that we are seeing, some include a worsening or deterioration effect before completion, which probably makes sense. But then we have also seen situations which say, if before completion we can project and determine that a couple of months down the line, this business is going to have a negative effect as a result of COVID, then they would want that opportunity to walk away or the opportunity not to invest. So that has brought quite a bit of uncertainty on completion of transactions. You could try from the buyer side, or the sell side rather, to introduce objectivity around a number of either the revenue drop or any other relevant factor that is applicable to your business, to just try and bring it some element of objectivity. It's not easy, given, of course, the apprehension some of the investors are also having, because it all, at the end of the day, depends on the risk appetite of the investor. And accordingly, particularly if the business is desperate for cash, it may be a bitter pill to swallow, but you just have to consider, or at least to propose some of those options that may bring objectivity. Around the CPs, things that we have seen include a COVID action plan, which probably has come out of due diligence. If the parties are clear on some of the issues that are affecting them, say either lack of or disruption in the supply chain, or issues relating to employees, and so on and so forth, then we've seen situations where parties then include CPs to come up with a COVID action plan to try and mitigate the effect of that and to facilitate completion of the transaction. Last, Ed, so that I bring it back to you, I don't want to spend much of the time, is you're also seeing quite a bit of a robust and stringent measures around the pre-completion covenants. So the standard covenants, which cover, of course, capex that can be incurred by the business before completion of the transaction, or matters such as recruitment of C-level managers. We're seeing the investors being a lot more stringent and wanting to be involved in that, to just ensure that the value or the effect to the business is not that drastic as a result of either giving a free hand or not having visibility on what exactly is happening on that front.
What are you seeing on CAK and competition authority approvals? Are things moving along as usual on the deals that you're doing with them?
Yes, the beauty with the CAK, and they've been very supportive on transactions, while of course they're also working remotely, is that first of all, the regime changed towards the end of last year. So there are quite a number of deals at the moment which do not fall within the notification threshold. So that has significantly helped in reducing the workload for the competition authority. Now, on those ones, which of course would still require approval, competition regulators typically have a concept known as a consideration around distressed assets, and that is something that is being used at the moment, that as a result of this pandemic, quite a number of businesses are suffering or are hurting. This cash is desperately required, while of course you still have your primary responsibility of assessing the effect the transaction would have on competition and public interest considerations. It would make sense for you to move very fast and facilitate approval of the transaction so that the business then gets the money. And that has been something good that has come from the competition authority, and they have been very supportive on that front.
Great. Thanks very much indeed, David. That's very interesting and very helpful. Darshan, let's bring it over to the tax side of things now. We were talking about what some of the major tax impacts have been on valuation. What I wanted to ask you was in relation to IFRS and adjustments for receivables, provisions that are having to be made. I think there can be quite a big difference depending on which classification you choose, actually, which could be very relevant for the audience here. Do you want to just talk a bit about that?
Yes, thank you. So most entities in Eastern Africa and Kenya apply either of two frameworks. We have IFRS for SMEs, which is meant for small and medium-sized businesses, but the definition of small and medium-sized businesses is quite vast and encompasses almost everything that's not listed or has debt on the exchange, etc., or is regulated. And then you have the full suite of IFRS standards, under which IFRS 9 on financial instruments and impairment, etc., sits in. And depending on which methodology or which framework that has been picked for preparing financial statements, the results differ. IFRS for SMEs has a much more simpler standard on impairment, which simply looks at when a debt becomes bad or when a debt is impaired and a provision is made. But once you move over to the IFRS, full suite of IFRS standards, IFRS 9 brings about a lot of complexities, needs financial modeling, looks at past history of collection, past history of debt, but also brings about something that we call forward-looking factors, which need to be factored, right? So somehow accountants and financial advisors need to become prophets as such, and look at what those forward-looking factors could or how they could impact the financial model. Makes it quite complex, a bit subjective at times, but the definite answer there is that we do see it reducing EBITDA. We do see provisions going up as a result, because you are now forecasting, or entities are now forecasting that every potential receivable, every potential investment in the book has an inherent chance of going bad. And as a result, we do see enhanced provisions. But more importantly here is that for everyone out there, I think as you close transactions or as you enter transactions, it's important to define which basis or which framework your investee is using, because they do differ at very few points, but the points that do differ usually lead to different EBITDAs, and would definitely impact your valuations. Thanks, Ed.
Thanks, Darshan. I agree with that. I'm certainly noticing that as well. And thanks for the sort of free tax advice that you've given us there. I'm going to be a bit cheeky and ask you for some more. I hope you're not going to be sort of sending an invoice across to EAVCA or to myself. But I think what you probably will. I think it's quite topical at the moment. It's not, so I suppose, specifically related to COVID, but it is something that's cropped up in the period. And I very much doubt the membership will mind us going into this just briefly. With the sort of changes and one or two negative things that have been happening in Mauritius, is that still a domicile that you're recommending in terms of structures for East African transactions?
So a lot is happening in Mauritius. I think the Mauritian authorities have kind of given a commitment that most of the issues will be resolved actually by the end of this month. But if they do not, we do see that from 1st of October this year, there could be drastic actions, inability of certain funds as well to invest through Mauritius. And as a result, we are starting to see a little bit of more interest going into Singapore as a jurisdiction. So from that perspective, a bit early to say. But first, from a Kenya specific perspective, we are starting to see that Mauritius is, from a tax angle at least, is not offering any additional benefit to any other jurisdiction. That's because a couple of years ago, the Kenyan legislation around tax was amended to bring in treaty shopping provisions. And as such, whilst Kenya has just ratified its treaty with Mauritius, a lot of those treaty benefits are not available anyway. And they are specifically available to only Mauritian residents. So holding company setup, etc., does not benefit from those treaty benefits. We are starting to see or expect to see that Uganda, Tanzania, Rwanda are likely to move into that that line of thinking as well, because this line of thinking is actually being pushed by the OECD. And as such, having a holdco in Mauritius or a setup in Mauritius or having a holdco in Singapore from a tax angle, from Kenya perspective, has already become tax neutral. So that's where we see a big shift coming through. My worry from a Mauritian perspective is that every few years we kind of go through this blacklisting and maybe technical issues coming up there. So from a stability perspective, and that's where I'm seeing a lot of investors are starting to consider Singapore as a more stable jurisdiction.
Okay, thanks, Rowan. That's very interesting. I mean, I think presumably Mauritius are going to do everything they possibly can for the golden goose not to die. So be interesting to see what happens over the next few months. All right, let's move back to our private equity team now. Can I start with David? Martha, I hope you'll forgive me. I'm going to ask you the next question, but only because he referred to it earlier. Transaction structures, David. I think, I mentioned in the summary that the problem with deferred consideration structures or valuation adjustment is you've got to have another emotional discussion post-investment, right? 2 or 3 years between investor and promoter. So we do our best to, as advisors, to get the deal closed and find an agreed fair value. you'd mentioned deferred consideration, so maybe you could just talk about transaction structures that you think work, that you're prepared to use at the moment.
Thank you, Ed. For us at Ascent, actually, even before COVID, we were already using some of these transaction structures, in the sense that in the SME environment, it becomes increasingly very difficult. For example, when you go through the books of accounts or you try and do your financial DD, there are always gaps that you come across in reporting. And once you come across those gaps, the question, like William was saying, is the willingness of doing a transaction. And should anything nasty crop up later, what do you do? How do you sort of cure anything that might sort of shake that the issue that you had earlier, because information wasn't coming through to enable you to close the transaction? So besides deferred consideration, I think deferred consideration is one of the toughest we've seen. We have not used that yet. But in the COVID environment, it's something that's being considered where money is placed on escrow, and then depending on performance of the business over the next 2 or 3 years, that money can then move to the sellers in case it was a buyout. But what we've seen more happening is more ratchets, use of ratchets and earnouts. Our preference has been more towards earnouts, where as a private equity investor in a business, we are happy if everything is looking up. So we will tend to sometimes get more shareholding in a business. So you're negotiating sort of a 40% share, but you end up owning 60%. And then subject to the business performing, then the entrepreneur can claw back shares. So we have a positive ratchet. We've also used negative ratchets, which didn't work very well, because many entrepreneurs then feel like you're taking the business away from them for perhaps a reason that wasn't in their control whatsoever. And you just point to the contract and say, okay, look, the contract says X, and X has happened, so I'm entitled to take more shares from you. But in Ethiopia and in Kenya and even in Uganda, we've used ratchets before, both positive and negative, and we haven't seen necessarily big oppositions to them. It creates a bit of an uncomfortable sort of nuance once it's being exercised, but if it's explained very well, it works. What we tend to do when we're doing our transactions is to insist on our counterparties getting proper advice. I was just mentioning one to a potential investment the other day that, look, we will insist that you get a proper corporate lawyer, right? And you'll pay for it. And we will not just get any lawyer. We will look at the lawyer you're getting and see if you're getting value for it or not, because we will know from the responses we get from whatever information we put on the table for you. And if we see that the responses are not coming through as well, we'll be telling you, look, you're not getting good advice, and you better get good advice. And so all those things are actually on the table, so that in the sense that clawbacks, in terms of you are at 40% and then now you're going to gain 9% more shares or 20% more shares, tends to work rather than I'm holding back your money. And also it depends on the level of control you're taking of the business. If you're taking control of the business, the entrepreneur will feel that, look, you are in control of the business. I'm not making any decisions. What if you made the wrong decision and that's what has led you to the bottom rather than to the top, and now you're blaming me? All these things must be thought through and agreed at the beginning. And what we do is we demonstrate to the entrepreneur that if we can't get that, then we walk away. Because we know that at the end of the day, you're just kicking the can down the road and it will come back to sort of bite you. We've had experiences ourselves. So the marks on our backs tell us that. So there are those where we clearly just say we walk away from the deal. It's fair, because we don't want to start having fights 2 years down the line or 3 years down the line. We are aware that even anybody owning 10% of your business can be a heartache to you, even if you own 90%. At Ascent, we prefer taking control, but it doesn't matter the shareholding of the counterparty, and especially if they were founder of the business, they can become a real problem to you going forward. But I think we are going into a region where you can't afford not to think about those instruments. So the advice I have for the likes of David Lekera and yourself, Ed, is you must make sure that you prepare the people in this thinking. We are going into a situation where people are asking us, 2020 is not a fair time to sort of think about valuation. Why don't you use 2019? Why don't you use an average? And we keep on insisting, we are not going to use an average. We are going to use the last 12 months, yeah? And on the basis of that, and then we think about the most relevant multiple to give. And if you feel it's too low or anything, we can then agree, see performance of the business, and we pay you any top up that we need to pay you, or you claw back some shares, you earn out some shares back to yourself. The one we've used most is more of the earn out or clawback of shares more than anything else, but deferred consideration we haven't used it as yet, but we know it's in the market and it's an option that we've tried exploring. Thank you, Ed.
Thanks, David. Excellent. I wanted to pick up on a few of those points. They're really interesting. But I think time-wise, I want to just move on actually and ask Martha. So Martha, you know, for the deals that you're actually reviewing at the moment, are there new structures involved that innovations that have come out of COVID, or like David was saying, are you sort of still really applying principles that you've used before, but maybe more so now because of COVID?
Yes, I think we're still applying principles we've used before, but we are trying very hard to take a longer term view. Can you hear me okay?
Yes, we can.
Okay, so what we've done is, instead of just looking at the last 12 months, in a number of situations, we are trying to look back, 24 months. In some cases, maybe even 36 months, just to see what would be, call it a full cycle, in order to make our analysis. Obviously, all businesses are not the same. There are those that have been more resilient in COVID, and there are some that COVID has really hit them hard. So for right now, we're probably going to take a pause on some of the more severely hit businesses that have been hit by COVID, because it's just going to be so difficult to agree a valuation with your sponsors. And we have limited visibility. Obviously in March, we had no visibility, but now in August, it's much better. But yes, we are in an interesting situation where your past is not necessarily an indicator of how you will perform in the future. So in terms of structures, yes, we have looked at, I would say, more at staggered payments, or if you like, the deferred consideration, but I would not necessarily call it an earnout. It's more to make sure that we are aligned with our partners over, call it the next 36-month period, until the businesses normalize and we have much better visibility. I mean, even if you look at some of the biggest companies right now, a lot of them are not issuing any forward guidance. I think that's what has surprised me the most, is that it's really very difficult to tell the future now from the past.
Yep, next few months are going to be the most tricky, I think, for sure. Okay, thanks. Let me just take a pause and remind our attendees that we're going to have 10-15 minutes for questions at the end. At the moment, I can only see one has been written. So do feel free to submit some more. Just write them on the Q&A so I can see them. If we only have a small number, I'm going to carry on asking the panelists questions. But we're really keen to hear questions from you as well. So do please submit them. The one I can see, Darshan, so far is on a technical one on IFRS. So you can be preparing yourself for that. But before we go to that, I'd like to ask William what I sort of felt was maybe a controversial question. In fact, I asked his permission beforehand on whether I could ask this or not, because I think it's a burning question. I think it's potentially controversial. He was, of course, brave enough to say definitely ask it. And so the question is, William, because of what's happening at the moment, do you think that LPs are likely to give GPs a bit more flexibility on time frame before exit and IRRs as a result of COVID, or not?
Thanks a lot, Ed, and I hope you can hear me better now.
Yes, I think it's got a lot better, yeah.
Okay, thank you. And I'm sure David was waiting for this answer because it's right into his alley. From where I sit, from an IRR perspective, quite frankly, I don't think LPs are going to. I mean, the results will be what they are. But in terms of explicitly telling GPs that we are going to be happy with 5% IRR, I think that's not likely to happen. In terms of exits, this is a very it's almost like a given in some way, because you can only exit in a market where there are buyers, and in a situation like this, unless it's a fire sale, quite frankly, I don't think it's advisable. Anyone in their right minds would not force someone to exit, because you're more likely to lose money than make money from that transaction. And for that reason, I think, without speaking for other LPs, it's likely that people will be more lenient with regard to timelines of exits, and a lot of LPAs or limited partners agreements do have mechanisms of extending timelines in funds. But so I think that's possible. But from a return perspective, it's going to be unlikely. For new funds that are being raised at the moment, I think that question of IRRs is probably more relevant. And honestly, some of these are very structural things. It's a copy-paste, unfortunately, very copy-paste kind of environment from what is happening elsewhere. And there's also a lot of hard mentality in the investor society, unfortunately. So it depends on how, who goes first. If one of the bigger LPs kind of signals that, we are happy to encourage GPs to continue doing this hard work, to reduce our return expectations, so that they are more likely to get something out of this business going forward, maybe. But at this moment, I honestly don't think that those conversations are on the table as yet. But it all depends on if there's a signal from one of the larger LPs that this is something that they're likely to play ball with. Yeah.
I could see David smiling in the first half of your answer. For the second half, not so much, but I'm sure he's confident of his returns. What I want to do, actually, sorry, is just maybe ask Martha, on exit specifically. Martha, are you, what would be your preferred exit routes at the moment? Or are you sort of thinking of, in some cases, putting things on hold?
Yes, we've actually put some of our exits on hold. Obviously, number one was because for some of them, the potential buyers could not travel. Some of the countries where we're invested in are still closed, so due diligence has been an issue. But there are, I would say, one or two processes that we have restarted maybe in the last 2 months. And these are businesses that, it's very clear that they have a positive tailwind out of the COVID experience. So it's not entirely excluded. We're looking at them on a case-by-case basis. Yeah. Excuse me.
No problem. One of your investees trying to reach you there in the background. Yeah, no, I think you're quite right. It's sort of probably case by case, actually. So great. All right. Thanks very much. What I'll do then is move to the external Q&A now. So the first question comes from Eric Magoo for Darshan. Darshan, can you read that, or do you want me to read it out?
Yes, I can read it.
Second one's for you as well. You're a popular chap.
Thank you, Eric. Your questions around IFRS 9 and on financial instruments, IFRS 13 on fair valuation, and I guess you are going to make me go back to school as well. It's a fairly technical question. Yes, I would expect that you do see large impairments coming through. Remember that both the standards do not have any exemption around COVID, etc. So post 31st December 2019, I would expect that you do see the impairment coming through. But more on IFRS 13 and convertible debt. Convertible debt gets very, very complex. Under IFRS, there's various ways of classification, which would end up leading to a potentially different result. But nevertheless, I think the standards would let you, or not force you to revise all your assumptions in your model, because you do have to consider forward-looking factors. So if you do see that there is some normalization coming through, you are able to cater for that normalization. And that's where the subjectivity also comes in. But to answer your question on convertible debt would mean we could have a one-on-one session, because I would need to understand the instrument in detail and where it falls under IFRS 9 and how it falls under classification. But overall, I do summarize that you should be seeing a fair amount of impairment adjustments coming through.
Sorry, just a quick point. I realize actually, question for Esther. Can the participants see the question itself?
Yes, they can.
Okay, good. You. All right. So would you like to go into the second question then, Darshan?
On cross-border trading, so this is where I suspect most jurisdictions are going to focus on, as every jurisdiction is also trying to protect their economy, etc. So a higher amount of scrutiny is going to come about on cross-border trade. A significant focus on TP, and at least from East Africa, Tanzania, Kenya especially, we are starting to see a bit of heat from the revenue authorities here. A lot of scrutiny around transfer pricing, around structures, around substance of structures is starting to come through. But one of the largest things that we've started seeing worldwide, Kenya already, is the introduction of taxes on digital services. So taxing Netflix, Amazon, etc., downloading of movies, etc. And this looks like it's a worldwide phenomenon. We've seen some of the developed countries also taking steps towards introducing mechanisms around digital tax. It's in nature very difficult to monitor and likely to lead to a lot more disputes. And we have already started seeing the US's view on this and pushback against economies trying to introduce this. I had mentioned the anti-treaty shopping provisions earlier, but one of the other things just to be careful around right now is the residency rules, both for individuals, both for corporates. In each jurisdiction, there are a lot of people who have not been able to travel, who could be stuck in a jurisdiction and mean that they do trip up residency rules and could end up changing the tax statuses of their holding companies, or also for themselves. And it's something to watch out for. Again, we are starting to deal with inquiries from at least a Kenya perspective, from KRA, regarding residencies of shareholders, etc. So it looks like that they are getting smarter about this as well.
Okay, I don't think we have any other Q&A from participants, so everyone's feeling a bit shy today, it seems. So I think unless anyone wants to put in a quick final question, then what I'm going to do with 5 minutes to go is just ask each panelist to quickly summarize. Should be more or less exactly 1 minute, the best way to cope with COVID impacts on valuation and transactions. And so I think I'll go left to right and start with David, please.
Thank you, Ed. Two things I will say. It's I think a lot has been discussed, but there's no certain way of doing things. I think industries are different. I think, like Martha mentioned earlier, there's some that are hard hit more than others. Others have a positive tailwind to it. It will depend on a case-by-case basis, but at the end of the day, we are here to invest. And the idea of sort of holding back might not necessarily work for all parties. If I put on my IAVCA hat on behalf of Western maybe and Eva, it would be good for me if the industry can start sharing a bit of information. We work in an industry where sharing of information is very, very difficult. We hear transactions have happened, and congratulations to Martha for closing a transaction pretty soon. We hear there's a lot of stuff happening. If we can just start sharing information in a way that doesn't compromise confidentiality, it will be very useful for the industry, right? Because we are finding ourselves more and more often having to use comparables that don't make sense. Whereas you know that transactions that are very close home have happened, and then you find yourself in a situation that's sort of not interesting. I also think, as a parting shot, is the environment, the operating environment, especially the regulatory environment in a place like Kenya, is becoming more and more, the nuances is becoming more unpredictable. We've seen from the Finance Act that was passed, this has become my favorite subject, that there's a lot of look into the private equity industry and what maybe the government can get out of it, and it's creating a bit of uncertainty to the industry that was sort of gaining some level of semblance of stability. So there's a lot of things that are up in the air, but yeah, we are here to invest, and the companies that are out there should feel that there is money that they can tap into to enhance themselves, protect themselves from sort of going under, or take advantage of the new opportunities that have been created by the COVID-19 crisis. Thank you.
Excellent. Thanks, David. Darshan?
Thank you, Ed. I think in the post-COVID era, reliance on historical numbers needs to be less and less. And I think as your investees, for example, need to be a lot more live with information. Any transactions that are up and coming, I think access to financial information must be live, because when I look at numbers on a daily basis from clients' perspectives, things are so fluid and changing month on month, right? And it's very difficult to rely on history. A lot of people don't know what's on the horizon as well. So that would be my take. I think to be current with numbers, I think reliance on current numbers rather than historicals is the way forward. Thanks.
Thanks, Darshan. And Martha?
Yes, just a quick clarification. I'm not closing a transaction. I'm opening a store. So we are painting Kisumu red for those of you who are here today. We are opening a new Quick Mart. So yes, the town will be red. But going back on in summary, I would say, obviously at this point in time, it's hard to rush any transactions, except maybe those that have a very strong positive impact. COVID has impacted them positively. Yes, I would recommend, take it slow and look at the longer term view. That's what we are spending a lot of time doing, is trying to understand and simulate what will things be like in COVID, with less people traveling or less people willing to travel, even once the borders are opened. What does that do to the hospitality industry? So really trying to understand what will be the knock-on effects up until the point we get a vaccine, and maybe afterwards. So I would say take a longer term view on valuation.
Thanks, Martha. William?
Yeah, so I think from my end, I agree with long-term view. I'm seeing a disruption in terms of valuations. Comparables are likely not going to be relevant in the most part in this environment, because you really don't know what are the fundamentals behind those multiples or whatever numbers people are agreeing on. So it's not necessarily very scientific, and therefore I think that might not be the most obvious thing to do when Martha closes the transaction and then you say, you know, she closed at 8 times, I'm going to use 8 times. I think that's not going to be the norm going forward. But finally, and most importantly for us, I think it's important that investors take this not as an opportunity to be punitive to sponsors and trying to punish them for COVID. I think we need to share the pain, and when we're negotiating with these entrepreneurs, realize that some of these effects is not because of them, you know, and therefore not investors not taking the seat of, you know, high road and trying to be, and we're the ones who are not going to lose in this environment. I think we are in a situation where for all of us to come out of this and still have businesses to invest in when things kind of stabilize, we need to look at our sponsors on the other side as partners, as opposed to people who are beaten, and therefore we're waiting as vultures to take whatever we can out of them. I think that's my potential.
Great, thanks, William, and a very positive developmental perspective. And then David, please.
Thank you, Ed. So I think there are a couple of key items that need to be considered from a transaction implementation perspective. Once, of course, the parties have agreed on what they need to do, or even before that, we probably would be seeing a lot more attention on enhanced due diligence, although that is easier said than done, really, given the complications of doing due diligence itself. At the moment, it's a lot more difficult to say visit a physical data room to review documents, yet in certain sectors like the financial sector, there are certain documents that of necessity must be reviewed from a physical data room. But that said, it just makes a lot more sense for investors to pay a bit more attention on in their due diligence on matters that are more affected or relevant as a result of COVID. You'll be looking at, say, the ability of the target to perform contractual obligations. We are seeing stories such as in the energy sector, the off-taker, the only off-taker we have, being a bit reluctant to comply with obligations on the grounds or on the basis of force majeure, which itself is, in itself rather, is going through a very robust interpretation at the moment through the courts and different other dispute determination fora. So that is one. I would also expect to see, and this is very important for both sides, a lot more attention on disclosures. For transaction lawyers, we tend to not pay more attention on disclosures, particularly if you're acting for the investor. If the other side doesn't want to disclose, then you really wouldn't be bothered that much. However, given, of course, what COVID is bringing about, it just makes a lot more sense for you to insist on requesting the target whether there is really something that specific that they need to disclose. And you've seen that in a number of transactions, things such as defaults in their debt arrangement, their facility arrangements with lenders, whether you're talking of your usual conventional lenders or others, which means if you are to proceed with a transaction without having addressed that, either by way of getting a forbearance mechanism or a waiver or some other restructuring element, then the process of your investment, which would otherwise would have gone to assist the target or was designed to help the target survive COVID, could easily, at least in theory, be taken by the lender through acceleration. So things like those, we think, needs to be given a lot more attention. We are likely to see prolonged periods for warranty claims, since, of course, there is no clarity on what would happen. In situations where we are seeing 12 months, we won't be surprised if people or investors push for 36 months or more. A lot more tailored warranties and indemnities. If, say, a business has some money or a challenge and as to ways to whether to pay a tax obligation to the revenue authority or keep that cash to keep the business going, or even to pay to the pension scheme employees deductions, you could find situations where they are tempted to hold back that money. That would have an effect later on warranties and indemnities. So it would be good and necessary to pay a lot more attention in tailoring and ensuring that specific warranties on things such as regulatory compliance. There are new laws coming up, such as health and safety laws. All those have been properly addressed, and you're able to cover yourself accordingly through warranties and indemnities. So I'll pause there.
Good point. Yeah. Okay. Thanks very much indeed. So look, I think we'll leave it there, more or less exactly on time. What I want to do is hand it back over to Esther, who hasn't got a chance to say so much so far. She'll probably want to do some closing remarks, I think, to her members. But let me thank my panelists. I really enjoyed that. I thought it was really, really interesting answers. And thank you so much, all of you. I really, really appreciate that. Thanks for your time. Over to you, Esther.
Yeah, no, I'll just say a quick thank you to all of you, especially you, Edward, for moderating, facilitating this conversation, and also for sharing, launching the report, the Valuations Impact Report, with this group initially. So we've had the first look at the report, and we're grateful for that. Darshan as well, I know you also worked on the report. We're really grateful for that, and I hope that the insights that have been shared there can be used to make better decisions moving forward for the industry. And for the panelists, I'm really, really grateful for both your time and your sharing your expertise with us. I know your time is very precious. Martha, you're all the way in Kisumu. Thank you so much for just dialing in. And we look forward to the pictures of painting Kisumu red as you launch your new Quick Mat. Congratulations for that and all the best with that. Thank you, William, for beating your sound issues as well. So thank you so much for that. I'm really, really grateful. David, from calling us in from all the way in industrial area. And for David Lekarai, I won't mention it, but we know what you did for the benefit of this panel discussion. So thank you so much. And also to the participants, thank you for joining in and listening in. I will echo the EAVCA chairman's call to the industry to share information. Please do so, just for a wholesome and better performing industry as a whole. So we'll reach out to you all to see how we can improve this and work together as an industry. All in all, thank you all and a happy Friday, and do enjoy the rest of the weekend. Goodbye.
Bye. Thank you all.
Bye.
Bye.